you ever wondered what a mutual fund is? This question leads us to an exciting journey into the world of investment. Let's start with the basics. A mutual fund is a type of investment vehicle that's made up of a pool of money collected from many investors. This money is used to buy a vast array of securities like stocks, bonds, and other assets. The main attraction of mutual funds: they offer small or individual investors access to professionally managed, diversified portfolios. Now you might be thinking, why is that a big deal? Well, creating a diversified portfolio on your own requires a substantial amount of capital, not to mention a deep understanding of the market. But with mutual funds, you get the opportunity to invest in a wide range of securities, even with a small amount of money. Now that we have a basic understanding of what a mutual fund is, let's delve deeper. So, how do mutual funds work? Well, mutual funds are a type of investment vehicle that pool together money from many investors, just like you. This pooled money is then used to buy a wide variety of securities, such as stocks, bonds, and other assets. By doing so, mutual funds offer a level of diversification that would be difficult, if not impossible, for individual investors to achieve on their own. Imagine you're at a grand buffet. There are so many delicious dishes to choose from, but you only have one plate. Now, what if you could share your plate with others and in return get a taste of everything on the buffet? That's how mutual funds work in the financial world. The fund is managed by professionals known as fund managers. These experts decide what securities to buy, when to buy them, and when to sell them based on their research and analysis. Their aim is to generate the highest possible return for investors within the fund's stated investment objectives and risk tolerance. As an investor in a mutual fund, you get a slice of the total pie. Each slice or unit represents your share of the fund's total value. The price of each unit, known as the net asset value or NAV, fluctuates based on the performance of the securities in the fund's portfolio. The beauty of mutual funds is that they provide access to a diversified portfolio of securities for a relatively small investment amount. So, whether you're a seasoned investor or a newbie, mutual funds offer a way to invest in a broad range of securities in one go. Moreover, mutual funds are highly liquid. This means you can buy or sell your units at any time based on the current NAV. And the best part, you share the profits as well as the losses with other investors in the fund. In simple terms, when you buy a mutual fund, you're pooling your money with other investors to buy a piece of the fund's portfolio. Did you know there are different types of mutual funds? Just like there are myriad flavors of ice cream, there are a variety of mutual funds to choose from, each offering a different investment experience. Today, we'll be diving into three main types: equity funds, fixed income funds, and index funds. Let's start with equity funds. These funds primarily invest in stocks. They offer the potential for high returns, but come with a greater level of risk. Imagine being on a roller coaster. There are thrilling highs and scary lows. That's what investing in equity funds can feel like. They're best suited for investors with a high-risk appetite and a long-term investment horizon. Next, we have fixed income funds. As the name suggests, these funds invest in income-generating securities like bonds and treasury bills. Picture a calm boat ride on a serene lake. That's the kind of journey fixed income funds offer, steady and predictable. They provide regular income and are less risky than equity funds, making them a preferred choice for conservative investors seeking stability. Finally, let's talk about index funds. These funds mimic the performance of a specific benchmark like the S&P 500. Think of it like a mirror reflecting an image. Index funds reflect the composition and performance of their benchmark index. They offer broad market exposure and are typically more cost-effective than actively managed funds. However, remember, the returns are limited to the performance of the index. Now, these are just three of the many types of mutual funds. There are also balanced funds, sector funds, money market funds, and more. Each type has its unique characteristics, benefits, and risks. It's a bit like choosing a car. You wouldn't buy a sports car if you needed a family van, right? Similarly, you should choose a mutual fund that aligns with your investment goals, risk tolerance, and time horizon. Each type of mutual fund has its own set of features, so it's important to choose the one that best fits your investment goals. So, take your time, do your research, and choose wisely. After all, investing is not about getting rich quick, but about growing your wealth steadily over time. So, what are the advantages of investing in mutual funds? Well, one of the key benefits is diversification. When you invest in a mutual fund, your money isn't tied to just one stock or bond. It's spread across a wide range of investments. This means that even if one or two assets in the fund don't perform well, others may still thrive, potentially balancing out any losses. Think of it like not putting all your eggs in one basket, but rather spreading them out to minimize risk. And then there's affordability. Mutual funds allow you to invest in a diversified portfolio for significantly less money than it would take to create that same portfolio by buying individual stocks and bonds. This is because mutual funds pool money from multiple investors to buy a larger range of assets than most individuals could afford on their own. In essence, it's like going in on a group gift rather than buying something expensive all by yourself. Next up is professional management. When you invest in a mutual fund, you're not just getting a collection of stocks and bonds, you're also getting a team of professional investment managers. These experts do the heavy lifting of researching, selecting, and managing the fund's investments. So, you're not on your own trying to figure out which stocks are a good buy or when it's time to sell. You have professionals making those decisions for you. And let's not forget about liquidity. Mutual funds are typically easy to buy and sell. Most funds allow you to sell your shares and get your cash back on any business day. This makes mutual funds a relatively flexible investment option compared to other types of securities that may be harder to sell or have minimum hold periods. Finally, there's the potential for returns. Like any investment, mutual funds come with the chance to earn money. This can come in the form of income from dividends and interest, as well as capital gains if the fund's assets increase in value. With their numerous advantages, mutual funds can be a great investment option for many investors. But like all investments, mutual funds also come with their own set of risks and disadvantages. First, let's talk about the potential for loss. Mutual funds, like any other investment, are subject to market risks. This means that if the market doesn't perform well, the value of your mutual fund could drop, leading to possible losses. While diversification within a mutual fund can help mitigate this risk, it does not guarantee against loss. Remember, the principle of high risk, high reward applies here. Next up, we have fees and expenses. Mutual funds are managed by professionals who charge a fee for their services. These fees, often referred to as expense ratios, can eat into your returns over time. Some mutual funds also have sales charges, also known as loads, which you either pay when you buy the fund, referred to as a front-end load, or when you sell the fund, known as a back-end load. Thirdly, let's consider the lack of control. When you invest in a mutual fund, you're essentially handing over the control of your investment to the fund manager. While this may be a boon for those who don't have the time or knowledge to manage their own investments, it can also be a disadvantage for those who prefer to have a hands-on approach to their investment strategy. You cannot choose the specific securities that are included in the fund, nor can you decide when to buy or sell them. Lastly, mutual funds may not be the best option for short-term investors. Some funds have a minimum holding period, meaning you can't sell your shares for a certain period of time without paying a penalty. This can limit your liquidity and flexibility. Having a clear understanding of these risks and disadvantages can help you make more informed investment decisions. Remember, every investment comes with its own set of risks and rewards, and it's crucial to understand these before diving in. It's always a good idea to consult with a financial advisor or do your own research to ensure that your investment strategy aligns with your financial goals and risk tolerance. So there you have it, a comprehensive introduction to mutual funds. We've journeyed through the ins and outs of mutual funds, unraveling the complexities of this popular investment vehicle. We've discussed how mutual funds operate, pooling resources from multiple investors to create a diverse portfolio of assets. We've explored the myriad types of mutual funds, from equity and bond funds to sector and index funds, each with their unique features and benefits. We've weighed the advantages of mutual funds, including professional management, diversification and liquidity, against the potential risks and disadvantages, such as market volatility, management fees, and the potential for losses. Remember, the key to successful investing lies in understanding, comprehending what mutual funds are, their workings, the different types, their benefits, and their risks is fundamental. Remember, investing in mutual funds is all about understanding your own financial goals and risk tolerance. Always do your research before making any investment decisions. Until next time, stay financially savvy.